Hey everyone, this is Hunter Satterfield, the Chief Investment Officer and a partner here at Kane Waters and Associates. As always, I am joined by my fellow partner, Brian Bortz, who is also the head of our investment committee, and then Brad Sanders from Tectonic Advisors. We are coming to you from the new offices of CWA. We're looking forward to hosting those that have not come yet. This is your March market update. For the month of March, the S&P 500 was up 3.7%. The global stocks were up 2.5%. Domestic bonds were up 2.5%. And then global bonds were up 3.2%. So as you can see from these numbers, they look the exact same as February, except they have a plus sign instead of a minus sign. And Brad, that's actually where I want to come to you first, because it was a month of a lot of turmoil, both with some issues in the banking sector related to SVB and several others. Yet we saw a really strong month overall that can sort of continued our message of volatility for the year. You want to talk a little bit about what caused sort of this market run up in March, and then also potential impacts on what's going on in the banking sector?
Sure. Really, I think at the heart of it is yields came down markedly. So what had been driving the market slower last year were interest rates moving higher dramatically, and interest rates moving up. I just said that interest rates moving up, and the strong dollar because of that was where I was going. And you kind of had a reversal of those trends after Silicon Valley. The market seemed to implement kind of a 2008 playbook there for a couple weeks. So you had gold up, dollar down, yields down. We think that's wrong. While it looks and smells, we talk about how history often repeats itself or rhymes. While this looked a lot like maybe the Bear Stearns part of the 2008 crisis, where you had a big bank going under kind of seemingly out of nowhere, the cause of it going under is completely different. In 2008, you had a big smoking crater blown in the asset side of the banking system, where you had all these mortgage products get written down to zero. That's highly deflationary. What you had here was just disintermediation in their banks held to maturity assets. And so what we think we have here is like disinflation, not deflation. So the market immediately priced in Fed rate cuts this summer. And then you had things like mega cap tech driving the market, which is what you would expect if you're going to have a deflationary tape, because tech companies like low to no inflation and they're asset light. So, generate a lot of cash that does a lot better for you when you have extremely low rates. The Fed subsequently came out, left up room for another quarter point rate hike, which we think they will do at some point. And then we're more of the camp that they're going to take a long pause. We still have inflation trending in the sixes now. We think it's on its way into the fours by the summer, but that's still well above their target. If the Fed does cut this year, we think it's going to be because of economic problems, if they are to occur, not because of what happened in Silicon Valley. From a banking sector, I think the net result of this is, I think the panic's over in a way. I think what the Fed and the Treasury did with the new lending facilities has kind of stemmed that, where depositors don't have to worry. I do think regional banks, are going to continue to be under pressure, because I think just from a human behavior standpoint, if you're a small business owner and you have an account that's above the FDIC limits at a regional bank, even though the Fed has said that money's going to be fine, you probably don't want the headache, right? So you're probably looking around. Maybe I'll get a big account at JP Morgan, keep some money at this regional bank, and you're going to have some of that going on. I think the banking sector in total is in pressure, because I think part of the fallout from this that's maybe underreported is that the average consumer out there has realized that, the money in my bank's been yielding. They're only paying me 35 basis points. If I put it in a money market, I get 4.5%. And so we saw like $600 billion move out of the large banks, just in the month of March. And that's where that money's going. So I think they had to do what they did. We can't have another savings and loan. Regional banks are very important to our economy to keep it competitive, and you don't want to introduce that level of moral hazard into our system. But I do think there's secondary and tertiary effects here that we're going to be feeling for the next couple of months. But I do think in terms of seeing another large bank of Silicon Valley's size go under, that's probably not going to happen. Never say never, but I think that the panic part is over.
Yeah, that's really helpful. Thanks for all that. And Brian, I want to come over to you. We're a quarter in now to 2023. You want to talk a little bit about some of the macro trends that you're kind of seeing, we're focusing on a little bit, and the potential implications on what we're going to see going forward in the markets based on those?
Yeah, thanks, Hunter. Brad, as he always does, hit the nail on the head and summarized a little bit about kind of what your lead-in was, Hunter. Last month, a lot of negatives in the indices. This month, a lot of positives. And when you look at what was creating those coming out of last month, the Fed was really hawkish, and they were saying, hey, this is what we're going to do, and this is how we're going to do it. And it was very, very predictable. And the markets loved that, and the economy loved the fact that the Fed was predictable. And then Silicon Valley Bank happened. And so the Fed had to, as Brad said, use a 2008 playbook. And they stepped up as kind of the lender of last resort to say, we're going to be supporting the economy and we're going to take care of that. Well, what ended up happening is the market overreacted joyously to that to some extent to say, okay, we're safe. We don't have a banking crisis. There was about a 2 or 3 day period where everybody was worried about it. And then all of a sudden the Fed says, we're okay. And you have 3 straight weeks where the S&P was up and the tech sector was up, real estate was up. Energy prices were down in March, but since then, first couple of days of this month, energy prices are up. And a lot of that has to do with OPEC's decision. So there are a lot of macroeconomic things that are happening right now that just preach to the fact of everything that we've talked about, where you're going to have volatility. You're going to have a negative February and a positive March, and you're going to continue to see that trend until we stabilize. I will tell you this, and we're not often in the position of making predictions here for sure, but I think that once the Fed, who has been very clear about what they're doing, once the Fed comes out and says we're done, or at least signals, all right, we're going to take that pause, I think the market is going to react very, very favorably to that, maybe overreact favorably to that. So we're going to continue to watch volatility. I wish there was a better answer than that, but the fact is that we're going to see a lot of ups and downs until we get a little bit more stability and the Fed feels that inflation is in check.
That's great. Yeah, appreciate those comments too. And as always, everybody, we will be back in front of you at the end of April with, sort of what happened in April. At this point, each time we record one of these, we've got plenty to talk about. So stay tuned to us, and we'll be back in front of you in about 30 days. Thank you so much.